Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value, and I was ripping through the comment section, reading all the comments, and I know some people, I guess, took offense to something I mentioned in the gold and silver technical analysis. So what I'm proposing here is I am very heavily invested in precious metals. I was probably far too overweight in precious metals in the early portion of 2020. I created this channel. I put a lot of thought into the channel about the name of it. I didn't want to be stuck into precious metals only. I didn't want to be stuck into commodities only. So I called the channel Finding Value Finance. And the reason I did that is because I could cross between any sector I want, and all I'm doing is finding value in the world. I just wanted to touch on that real quick. Someone said you're basically pushing a self-fulfilling prophecy because you sold out and are now trying to drive prices lower for your own benefit. Fortunately, so few people watch your show that there's no impact. By the way, the time to get into rare earths was last year. Now they're overpriced. remx is an overvalued company. So I am very heavily in precious metals. I have 20 to 25% of my entire net worth in physical precious metals. If you've heard my videos, my previous videos on ratio investing and swapping these metals back and forth to increase your ounces of holdings over time, and that strategy has provided returns that are better than the S&P 500 on average, not since COVID, but on average. It's one way to diversify my holdings. It's outside of the system. It's the most private way to invest in anything, and it's off the grid. So it's a diversifier. Then 40% of my entire net worth is in equities. In those equities, I have a good portion in my 401k, 40% or something like that. I can only go into mutual funds in that 401k. I can't go into ETFs. It won't allow me. And it's a pain in the butt to take money out of my 401k and transfer it to a rollover IRA when I'm actively working. I'm just going to leave it as a diversifier so it doesn't allow me to get too crazy with too much money. Now, I can't buy a rare earth metal fund there. And what I want to do, because let's say my entire net worth, 40% of my entire net worth in precious metals related equities and physical metals. I'm trying to diversify that out a little bit. I'm too overweight. And I wanted to explain this to everyone. I am still vastly in this game. I didn't sell out of anything outside of putting some companies into a free ride. Now, I'm not going to sell my physical precious metals. I never sell that. I'm not going to sell my mutual funds. So that leaves me in my higher risk portfolio is the only spot that I can, one, buy the ETF REMX, and two, if I'm going to sell some of my holdings, I'm going to sell my higher risk holdings. You've heard me talk about oil and the increasing input costs of oil. So what I did is I put some of my higher leverage companies into free rides. A free ride is letting your profits ride and taking your original amount out to diversify it into something that you might think is a good opportunity or a better opportunity at that time. So we are breaking these very large chart patterns that you saw in that technical analysis. Some of them are breaking to the downside. I said, well, I'm going to put it into a free ride and beef up my holdings of rare earth, the rare earth metal fund. That rare earth metal fund has lithium in it. It has some cobalt in it. It's got rare earths. It's got all these different type of rare earth metals in that portfolio. And I thought it was a pretty good mix. I don't have much exposure to lithium. I don't have much exposure to rare earths. It's very low in my portfolio. So I was like, I have to diversify out a little bit because I have so much in physical and the equities of precious metals. A big portion. So I sold some of my higher, riskier plays because I had to buy it in that account. So that was Discovery Silver, EXK, AG. There's a couple of other ones. I just reduced. I took out and put it into a free ride because I want to bulk up my rare earth metals, and the chart looks really good on REMX. It's breaking to the upside. It's got a cup and handle pattern. The price projection is gigantic. So I want to diversify out. So I'm going from a 40% holdings of physical precious metals and equities, trying to get it down some, and it had barely made a dent in that number. And I have 0.01% or less of my net worth in rare earths and lithium. I have hardly anything, and I want to beef that up. I have a good portion in energy, that's uranium, natural gas, and oil. They make up a big chunk in my riskier portfolio. I do have a little bit in a mutual fund as well. So I'm too overweight in precious metals, and I want to get more in rare earths and lithium, because I do think that's a good spot to be if we're going to ramp up electric vehicles, or maybe we have to ramp that up. And I think if we're going to do all this stuff, we're going to do it pretty soon. So there's another person that said, you lost us a lot of money, Andy. Thanks. He's probably talking about, okay, this is, oh man, I just noticed I accidentally put, why do I have the uranium sign here on the gold and silver? That's funky. It says not lose. So I'm sorry that you lost money. I don't know which companies that you purchased, but I have a strategy. It's not short term. I'm going to call the technical charts whatever way I see it. If I say it's going to go down, it's going to go up. But the ratio in uranium is extremely good. We are under the cost curve of the high cost producers in uranium. I think uranium is a great bet for a long-term investment. A long-term investment is greater than 5 years. I haven't sold anything in my uranium portfolio. It is still, everything's still in there. I've been accumulating over this pullback and will accumulate at the bottom. I've been accumulating more Nova royalty as well. I'm not telling you guys to buy any of this stuff. This is only financial education. I'm telling you my strategies. I'm telling you my holding lengths. And in the short term, you are going to be moving up and down quite dramatically. That's the price to pay for volatility and trying to go after these very large gains. You're going to have to go through this volatility. Now, just because something is cheap doesn't mean that it will go up. It will still be volatile. It's still going to move around. But the only way that you can really buy half this stuff is you're going to have to buy it when it's cheap. If you don't buy it when it's cheap, you will get absolutely slaughtered. And if you think 20, 30, 40% is bad, you're going to have to go through these ups and downs. It's the way it is with these high volatility companies. And you try your best to time it as best you can, but no one's perfect. We're all humans. And I do wish everyone the best on this channel. Again, I have, just looking back, I need to beef up rare earths in my portfolio, so I may sell some. I may even lighten up some more on some other things because I don't have a exposure to it. And that's why I'm gonna let you guys know exactly what I'm doing. I'm gonna be as transparent as I possibly can. And if people get mad at that, I'm sorry, but I'm gonna tell you what I'm doing. I'm not gonna be secretive about it. I knew that some people would be pretty mad when we get a pullback and consolidation period. This is investing. Consolidation periods happen, pullbacks happen. It is inevitable. It will happen, and it will always happen. It always has happened. So the way that I view these things, I mean, I was down at the bottom of COVID. I was probably down 40 or 50, 40% on, well, I bought it about 900 in platinum and went all the way down to 630 was the low. So that was, $300 over $900, 3/9, 1/3. So I was down 33% on my physical holdings in platinum. And what I did is I just bought more. I cost averaged in. So cost averaging in, taking a slow approach, try to read the patterns as best I can. And if you guys go try to read some patterns, try the best you can, and go for it. I mean, now another thing I want to keep in mind, what I just said there, my riskiest portfolio that I have, 40% is in that risky portfolio of everything. In some of these, I have like 6 or 7 portfolios. They're all over the place, based off of wife's rollover IRA, wife's individual account, wife's Roth IRA, which are all different areas. My IRA, which is a rollover IRA, a Roth IRA, an individual account, and I open up another like account or two because the fees to buy some of these OTC companies are cheaper based off of wherever you go. So some is TD Ameritrade, some's Charles Schwab, some's Fidelity. They're all over the place. So I don't go into all those portfolios all the time. I go in there, I buy some stuff, and then I leave it. In one of my portfolios, I'm trying to get more rare earth exposure. So some of the stuff, I don't look at it all the time. And I look at my bigger one that's got more of a spread on it, so I can just see what things are doing, get it in front of my face. But over time, I am buying lots of royalty companies. That's kind of where my focus is at. More royalty companies, less mining companies. I'm not in very many exploration companies with any sort of money, like a good chunk of money. They're all super hardly anything. So when I say I'm going to buy a company, I'm going to give you an example. PLG is a platinum group metals. That's a developer. It's got some higher risk to it. Now, if I take a 0.5 or 1% allocation, but remember that's only 20. That might only be 20%. I'm talking of that portfolio. So if it's 1% and it's only let's say it's 15% of my entire net worth, I'm putting 0.15% of my entire net worth in it, which is like hardly anything. Hopefully this is getting across. Like when you might be putting 100% in your portfolio and that's your entire net worth, and you guys might be putting 15% or 10% or 5% in one position. I'm at 0.15% of my entire net worth in that one position. It's not very big. And I talked about this before, risk-adjusted returns. You guys are probably taking on too much risk and trying to get your returns. I'm taking far less risk. That's why I hold boatloads of physical precious metals. I consider that to be a far lower risk. In my other portfolios, let's say it's 50%, 40-50% is a 401k of 40% of my net worth, I'm now left with 20%. Some of that I have royalty companies in. I may have 5% of that strictly in royalty companies, and I'm trying to increase that. I'm trying to make some money in some of the mining companies, the smaller ones, grow it up, put it into a free ride, and then put that into a royalty company. So what I'm doing is I'm making money in some of these higher risk areas, and I'm continually transferring profits, or my original investment, and protecting it and putting it in lower risk stuff like royalty companies, physical precious metals. I'm continually moving it over. But if the chart looks good and everything looks good, I'm going to let it ride. Now, also keep in mind, when I'm up, if you're up 300% in a company and you take out your original amount, you're still leaving a lot back there. You know, let's say you put in $5,000 and you go up 4x. Now you're at 20 grand. You take the 5 grand out, you left 15 back, and you took 5 grand to put somewhere else to beef up something that you might want more exposure to. And that's why I did it. So hopefully this gives you an explanation. I wanted to go over some portfolio. The key is here, I go over a lot of companies, and I know that people are probably going to look at it and they're going to want to go into something. The short-term technical analysis has the least amount of probability of success. The longer time frames you get, the more and higher success rates you are, but you're going to have to be patient. You're going to have to ride through a whole bunch of volatility to get where you want to go. No matter what sector you're in, you're going to have to ride through volatility. And commodities are probably one of the worst for volatilities, but can be the most rewarding in the shortest period of time if you get this right. So you guys are probably overexposed. You got too much allocated to it. And that's probably what's making you a little bit queasy here. So I've got very small position sizes in anything that's near an exploration company. I might say, hey, I'm gonna buy some in this. It may only be 1% of that portfolio. 1% of that portfolio might only be 0.1% of my entire net worth, which is super, 0.01%. Sorry, 0.01% or something on the lines of that. Now you got me curious. If it's 15, let's say it's it's probably only 10% or something times 0.01. Yeah, 0.1% of my entire net worth. I might be putting in some of these uranium exploration companies and whatnot. And when I say overweight one, I might be putting 2 or 3, 4, 5% in that one portfolio that I have. It's not of my entire net worth. So I think position size, risk-adjusted returns. If you're getting too risky with your stuff, pull it back, dial it back, get something that's not as risky. And I like the royalty companies, baby. I don't have a ton of copper. I have some of the big diversified mining companies, but I'm trying to get more Nova. I want Nova royalty. I like that company a lot. Hopefully this reaches you, and hopefully you're not too mad. I wish the best for everyone on this channel. I truly do. I hope everyone kills it over this next bull market. And if something happened, I'm sorry that happened. But let's go forward. Let's learn from it, and let's keep digging in there and finding value and investing in companies and position size correctly for the risk that you're willing to take. Thanks for listening. This is Finding Value.